Joining us here at Post 9 this morning, Strategas Research Partners Chairman and CEO Jason Trennert is with us. It's great to see you, JT.
Good to see you,
so
Carl.
we're in this period where sometimes the viewer hears, oh, when inflation crests, it's good for the market, but then the big question is whether you finish that in recession or not, right?
Yeah, I think that's true. I mean, there are a lot of people that I know, especially, let's say, growth investors or people who are bullish, they're almost praying for a financial crisis to get the Fed to ease. And what we're trying to tell people is that actually, after a series of hikes, the first ease is not particularly good for stocks, believe it or not. This is almost the eye of the storm between the last hike and the first ease. Market does okay. First ease, usually the lags associated with monetary policy are such that you're already in recession, and that's when you're at risk. But I think a lot of the indicators now are really suggesting that a recession is likely this year, and markets never bottom before a recession, and that's why we're trying to play the odds and be cautious.
You think you would have said that if Silicon Valley, if the regionals hadn't been an issue?
Well, listen, I think I would have, but I think that whatever your odds were for a recession before Silicon Valley, and for us they were pretty high, but they've got to be higher now, right? And we're going to get a lot more data from more than just the big money center banks and see how that is. But clearly, willingness to lend has gone down. There are no two ways about it. And for small companies, particularly small companies that do a lot of the hiring, they're very dependent upon bank lending, not necessarily Wall Street or private equity or venture capital or all these other avenues that big companies have. They're very dependent upon their local banker and the equity in their home.
I was talking, Carl mentioned Quincy of Coke. I spoke to him this morning, and he was saying about recession, it's like waiting for Godot. You know, it feels like ever since the Fed started tightening in March of last year, people have been waiting for a recession. You're not getting that from the color and commentary from companies. No,
that's true. And I think the big dog that hasn't barked really has been employment, right? And that's important because the Fed, from this perspective, is very much of a Phillips curve organization, which means the Fed spends a lot of time focusing on the labor markets, and that's why it's hard to see the Fed easing until you see real weakness in the labor markets. The unemployment rate at 3.5% is full employment by almost any normal standard, or more than full employment, right? So this is a little bit of the push and pull that you have. You might be okay right now, but you can't have it both ways. Either the economy is okay and the Fed's going to stay tight, or the economy is weakening, at which point the Fed will start to ease, but then you're going to have to deal with the aftermath of a recession.
So you're in the recession camp and expect the market to sell off. So what do you think breaks the strong employment?
It's going to be earnings and margins. I think one of the things that's happening with earnings, if I may be so bold as to suggest this, is that earnings look okay a little bit because of the money illusion, which is to say that inflation is higher. So earnings are going to come in a bit higher because revenues are coming in a bit higher. But if you look at margins, profit margins have declined pretty meaningfully, almost 300 basis points from the peak already, and they have more to fall. They're pretty mean reverting, and so that's something I would say, Sarah, that ultimately when you get margin compression, that's when people start to have to make hard choices, particularly as it relates to employment. No one wants to lay people off, but I think particularly in the technology sector, you're starting to see certain companies like Meta lay off people for the second or third time, which is, I think, suggests that there's perhaps more pain to come for companies that don't have very, very high profit margins like Meta.